Hi, and welcome to Retiring Right Success Strategies for Business Owners. My name is Jim Friesen. I'm a partner at Portage M&A Advisory. And today we're going to be talking to business owners in the lower mid-market about selling their business. Coming to you in a very interesting time when we're all dealing with the pandemic. So we're going to layer in some information about the COVID-19 and really what this means for people who are at the point where they're looking to sell their business, but they're also conflicted about whether or not now is the right time to sell. Who's this presentation for? As I mentioned, it's for business owners, for people looking to sell their businesses within the next 1 to 3 years. It's also beneficial for folks who touch M&A transaction, such as business advisors, lawyers, accountants, or just generally those who are looking to sell a business or buy a business and learn a little bit more about how COVID has really affected businesses in the lower mid-market. Our focus today is really talking about transactions in the lower mid-market. We define lower mid-market as businesses worth 1 to 30 million. So a little bit about me. I grew up in a family business, really enjoyed watching my father grow the business. Was fully integrated into it. I had brother and sister who were also involved. It was a great learning experience, and really, I think I did get the entrepreneurial bug from my dad, who was the founder of our family business. And after spending some time in the family business, I decided to go into the professional world, and I worked for larger private and public companies and got great experience there, and also went to a national accounting firm and got some valuable experience there. And at the end of the day, what I realized is, the experience working in the family business was phenomenal. In fact, there was a lot of passion still there while I was working for the larger organizations. And that's what brought me to Portage, is the idea of helping businesses, some of the smaller Canadian businesses that really need some assistance and guidance in selling their businesses. Interestingly, when my dad was looking at selling his company, I was working at a national accounting firm at the time, and he reached out and said, "Hey, I've got an engagement for you. Can you help me?" I talked to some of the folks at the firm, and I quickly realized that, the larger firms are really good at larger transactions, typically 20 million and above. But my dad's business wasn't near that large. It wasn't worth nearly 20 million. And so when I was looking around to see who could assist, given that the business was located in the London area, which is a little bit removed from the bigger cities, quickly realized there's not a lot of expertise in general in the M&A space, and that's ultimately what got me to where I am today. Just really passionate about helping small and medium-sized enterprises, taking what I've learned from the national accounting firm and some of my experience at some other larger companies and applying it in this market. Today we've got offices in Hamilton, Niagara, and Toronto, so we've got a pretty good reach, and we're still looking to expand. So what is this presentation about? The entire series is going to cover 4 parts. We're going to talk about assessing the level of retirement readiness, the steps involved in selling your business, and also the tips on preparing your business for sale. And lastly, how do you put all the pieces into action? How do you put a plan together, and how do you execute them? For purposes of today's presentation, we're going to cover off the first 2 parts. So let's get started. Let's talk about the evaluation, which is assessing your level of retirement readiness. So when talking to business owners, retirement is oftentimes very different than talking to someone in the corporate world who's got a pension plan, knows that at 60 or 65, their pension plan is sufficient to cover retirement, and they're off. For business owners, oftentimes retirement is a sticky subject. They don't know what the value of their business is, and they don't know whether or not they can afford to retire. So if you're in a position where you're not sure what retirement means, if it's a good thing or a bad thing, hopefully we can shed some insight onto what you need to do to really better understand that. So perhaps, this is the image you have of retirement. Or perhaps, you're on the other side of the coin and you can't afford to retire. Your business has no value and you're left with sleepless nights. These are the important things really that one needs to consider. Are you ready to retire? How much money do you need in order to retire? And what does it really mean for you? Is retirement right for you? It's another question that I think is important that one needs to consider. What do you do with your business? Do you pass it down to family? Is there family you can pass it down to? Is there management in place? Who's gonna fill your shoes? What is the business worth? Is it saleable? Are there buyers out there who are looking for a business such as yours? And what do you need to have for your business in order to fund your lifestyle? Another key question that people need to consider is, what are you going to do when you retire? What do you look forward to? Do you want to spend more time with family? Have you thought about traveling, taking that elaborate vacation that you planned for years and years? Have you thought about spending time on the golf course or taking up a new hobby? How about relaxing, moving at your own pace and not having emails and fires to put out on a daily basis? Or perhaps you're looking for another adventure. For many, the thought of retirement is really frightening. It's really the unknown. It's something they haven't thought a lot about. The thought of spending more time with family is frightening because, they've spent the last 30 years at work, and being at home for an entire day might be very anxiety producing, not only for the person who's going to be at home, but perhaps for the spouse who's not used to having someone, perhaps in their kitchen or watching them over their shoulder. The other key piece that's really frightening is the identity and the loss of identity. Perhaps you're known as the business owner of company X. If you're no longer the company owner, what does that really mean to you? Are you going to have something to do? Are you going to be very bored? And last but not least is really financial security. Is it a scary thought thinking about whether or not you can fund your lifestyle? You know what? At the end of the day, though, there's a lot more to consider than just the numbers. Michael Jordan's a prime example where he left the NBA. He was in the spotlight. He left basketball as a hero, as someone who achieved almost everything possible in the game. And after he left, he really struggled with an identity crisis. He was still relatively young. He had a lot to give. He had a lot of energy, but he no longer had the same routine. He no longer had the same appeal as he once had. And that's ultimately what drove him to the game of baseball. He was looking to make his mark. He was looking to get back in front of the camera. And that was driven by the wrong reasons. It was driven by an identity crisis. And it's something that you really want to avoid. It's something that you need to think about. So as you start thinking about retirement, you want to think about what retirement means to you. You want to think about what a routine would look like. And you want to make sure that there's some sort of plan in place. The last thing you want to do is really wait until your business is gobbled up by a buyer and you're at the point where you got to figure out what your schedule looks like the following day. That can become extremely stressful. In fact, if you look up the American Institute of Stress, you're going to find that they have a ranking, and retirement is actually right up there. It's a very stressful event for many, many people. So how do you avoid this identity crisis in retirement? And when the American Institute of Stress went and polled individuals, many of them said that, not knowing whether or not they could afford retirement was the most stressful element. They hadn't done enough analysis. They haven't really planned. And that's what was keeping them up at night. Some of the things that they could do to really avoid the financial piece is really working on a part-time basis. maintaining their mental health by maintaining relationships, staying plugged in with colleagues, perhaps even customers and suppliers. So going back to the financial security piece, what is something that you can do to ensure that, you don't struggle in this department? Ultimately, what you want to do is have a personal financial plan, a plan that looks at your lifestyle expenses. It looks at what you're paying for out of your own pocket, what your business is paying, ensuring that, there's a distinction between who's paying for it. Once you're no longer the owner of your corporation, you no longer be floating these expenses through. So you want to make sure you understand the true cost of your lifestyle. The other key piece that is really important is knowing what the value of your business is. Will the value of your business, in conjunction with all of your other investments, will it be enough to really fund your retirement? Perhaps when you do the analysis, you're going to find that, hey, I already have enough money to retire. Why prolong the process? Let's move into selling the business. Or maybe you're on the other end of the spectrum where you need to continue to work for a few more years. But either way, if you get the first two elements checked off your list, you're going to be in very good shape. Recruiting a team of advisors is a next piece. Is really critical in all of this. There's a lot to it, especially as a business owner. There's the tax implications. There's the legal stuff you need to be thinking about. There's the personal stuff, investment stuff, the wealth planning. You want to make sure that you're surrounded by a good team of quality individuals that can guide you through the process. And last but not least, there should be a plan in place, and there should be collaboration amongst the team of advisors. So how do you calculate your number? And when I say calculating your number, is how much do you really need in order to retire? What are your lifestyle goals and needs? What we recommend is really sitting down with a CFP, a certified financial planner, another wealth planner who works with business owners, understands how integrated the business is into how integrated their business is when it comes to their personal finances, is able to make the distinction between the two and really capture all the complexities involved. So it's something that you would want to ask when you sit down with a financial planner. How many business owners do they work with? Do they factor in the value of the business? Do they factor in tax planning? These are all questions you're going to want to ask. Here's an example of a financial plan that I got from a financial planner. He basically laid out, what retirement would look like. They plugged in the portfolio, the value of the portfolio, the cash required to fund retirement, and thankfully, as you can see what's circled there, you see the green bar. Based on this information, you have sufficient investment capital to meet your anticipated income needs. This really says you have enough money to retire. And that's likely what you'd want to see before you take the next step of selling your business. In summary, retirement for business owners is very different than the average employee. It's complicated. You want to have a team of advisors that are looking at the various aspects. You also need to consider identity crisis and a change in routine. This is not something you want to put off. It's something you want to deal with 2 to 3 years ahead of retirement. You may want to be picking up a hobby. You may want to start golfing part-time, knowing that eventually you're going to have the time to do it full-time. You want to have something that you can go to after you do retire. Also, you want to maintain relationships. You want to make sure that if you're spending 12 to 16 hours a day at work, that you've got some form of relationships that will continue on after the sale of your business, whether it's with close friends inside the company or advisors or customers or suppliers. You need to make sure that you do have a social network as well. And last but not least, having a clear plan. So once you have your deal team in place, you've talked to your advisors, there should be a very clear plan that addresses timing, that addresses roles and responsibilities. Once you have this piece in place, you can begin executing. Part 2, the process. So what's involved in selling your business? Before I jump into the specifics, what's really important, and it's something that's always amazed me, is how many small, medium-sized businesses there are in Canada. Out of the 1.2 million businesses in Canada, um, 98% of them have less than 100 employees. That tells us that most of the businesses in Canada are small and medium-sized businesses. They account for almost half of overall GDP for Canada. Small businesses also employ over 8 million people in Canada, and that accounts for about 70% of the total private workforce. It's a huge number. And then if you break it down even further, 78% of all businesses are service-based, while 22 would be considered businesses that produce goods. So I guess what I'm trying to illustrate in this slide is the small and medium-sized businesses are definitely a huge segment of the Canadian economy, and oftentimes it's overlooked. If you pick up a book on business, oftentimes the focus is on publicly traded companies or really large enterprises. The reality is, as you can see with these statistics, there should be more focus on small and medium-sized businesses, and the M&A process is no different. The process for smaller business is very, very different than large organizations. So, this is something to keep in mind when you're looking at hiring an M&A advisor. Are they well versed in the lower mid-market? Here's some more Canadian statistics that I got from the BDC. They found that more than 40% of entrepreneurs will exit their business in the next 5 years. That's a pretty large amount of people exiting their business. The question has always been, is there a sufficient buyer pool to take on these opportunities? The other piece that they identified is that about half are expecting to sell their business outside of their family. Traditionally, it was very common to pass it down to the next generation, but what we're seeing as well in our firm is that more and more people are going to market. People need the money in order to fund their retirement. They can't simply afford to pass it on to family. It's becoming more and more common. Also, about 50% of small, medium-sized enterprises are owned by individuals that are at least 50 years old or older. So a lot of the business owners, 50% of them, have been entrepreneurs for a long period of time. So there's a bit of a gap between entrepreneurs today starting businesses and those looking to retire. So there is a big cohort that is about to exit. So the question is there going to be enough folks who can take on and meet the needs of customers and take on the businesses from the baby boomers? And it really interesting, and this is a really important consideration, especially if you're looking to sell your business, is, a lot of business owners in the lower mid-market, as they get closer to retirement, they take their foot off the gas and they decide to put less and less money into their business. And this is probably one of the biggest mistakes one can make. It is a common trend. And what BDC illustrates here is that people have no issues investing in their home. It's a huge asset. They know that it's an asset that typically increases in value. So why wouldn't you invest in it, right? And so if you take the same approach and say, hey, your business likely makes up the largest piece of your portfolio for retirement purposes, why wouldn't you invest in it? And I agree. I think it is a bit perplexing, but it's very important that you continue to invest and keep your foot on the gas right to the end. So here are the 6 steps that BDC identified that people can do to enhance the value of their business. Keep reinvesting, as I mentioned. Pursue growth. Make sure that there's still sales growth. It becomes very appealing to buyers. Ensure that there is sufficient financial reporting and management reporting so that when people come to the table, they can evaluate the business appropriately. If there's no information to evaluate, the risk is significantly higher. Even on the banking side, funding the deal will become that much more difficult. Make the business stand out from the crowd. At the end of the day, what buyers are looking for is free cash flow. They're looking at profitability. They're looking to plug themselves in. Make sure that the people you're competing with, which is other businesses and businesses within your industry, make sure that there's something unique and special about your business. Focus on the quality of buyers, not quantity. And, make sure you have a good M&A advisor who has a good marketing strategy and getting the right people to the table. And lastly, you know what? Buyers can come from outside of your region, and they may even come from different industries. So you got to cast your net really wide to ensure that you get a good number of suitable buyers and you keep the value of your business as high as possible on sale. So our experience with sellers in the lower mid-market, typically when we see people, they don't have a clear exit strategy. They come to us and say, hey, I'm looking to sell, almost treating it like the sale of a home. It's obviously not the case. Oftentimes people don't know what their business is worth and they have unrealistic expectations. They're coming to us and saying, listen, I need $1 million in order to retire. Yeah, I'm looking to sell my business. If you believe you can get $1 million from me. Unfortunately, that's not how it works. The reality in the lower mid-market is what a buyer's willing to pay or really capable of paying is fair market value. People are very dialed into the value. And even if a buyer were to come to the table and offer you much more than fair market value, the bank would likely dial them back and say, listen, you're overpaying for this opportunity. We can't fund the entire transaction, or we can't fund the transaction at this value. So, believing that you're going to get more than fair market value, I would say is somewhat unrealistic. A lot of the businesses we see too are actually not saleable. They don't have all the pieces in place in order to meet the buyer's criteria. Just because they haven't planned in advance, or they're not profitable enough, or there's some red flag, such as owner dependency that's standing in the way. So make sure you speak with someone well in advance of going to market and looking to sell your business, because there is sufficient time required in order to make sure everything is ready to go. Oftentimes too, there's a lot of misguided information out there, and people will come to us and tell us, certain things that they've heard or seen, or something that their advisors have recommended. And oftentimes it doesn't align with the realities. And, make sure that the information you have is fact-based. It's being told to you by someone who operates in this space, who has done deals in this space, and has information that they can show you to really verify what the facts are. Another piece that we often see is business owners don't believe that there's actually a pool of buyers. And what I can tell you is the lower mid-market has become increasingly popular. There are people looking to buy a job, and there are also serial entrepreneurs looking for a good investment. A lot of serial entrepreneurs and those with extra money would almost favor buying a business versus putting their money in the stock market. And it's becoming, quite a trend. So keep in mind that as long as your business is saleable, there's likely a buyer out there who will benefit from a business like yours. Lastly, everything the pieces that BDC recommend in terms of optimizing your value, we fully agree with that. I think you have to invest in your business, keep your foot on the gas, and make sure that you find a suitable buyer. That's really the key involved in making sure you get fair market value. The rules of thumb in the lower mid-market, here are just some of the realities that remain true, and these are just really the expectations that a seller should have when they're selling their business. And again, we're talking about businesses valued between 1 and 30 million. There are two buyer profiles. One, an individual looking to buy a job, and these are typically the businesses on the lower end of the spectrum. The second is savvy investors looking for an investment. They're not looking to buy a business where they're working day to day. Management is either already in place, or they would be putting management in place. They'll likely be involved to a certain degree in the strategy, keeping their finger on the pulse, managing the KPIs and that sort of thing, but they're not looking to buy a job. So those are the two essential buyer profiles that you can expect to see in the lower market. And again, in terms of valuation, we get a lot of people Googling, we get a lot of people talking to their aunt or uncle who have Googled, or an accountant, or or a so-called expert, and they're coming up with ridiculous valuations. And what we typically will tell people is, you can expect to get 3 to 5 times normalized EBITDA. If it's above that, you probably have a unicorn in your backyard, and it's something really, really special. Pretty rare to be above a 5. So keep that in mind. So if your expectation is, double that, either you have no competitors and you have the perfect business, or your expectations need to be adjusted. In terms of saleability of a business in the lower mid-market, really what it comes down to is, will the bank finance it? Is it profitable? Is it marketable? Is it something that a buyer can plug themselves into? Or is it a business where you are the business, you're the sales force, and when you leave, the customers leave? That's really the key piece in saleability. When it comes to financing the business, what we typically see is the bank will finance about 60% of the transaction. So they want to make sure that the buyer puts some money down, that the seller is going to finance a certain portion so that they remain invested to a certain degree, and that the business can actually sustain the payments that are going to have to be made when the buyer uses debt to purchase the company. And on top of that, they're going to have to make a decent living. And that's usually the test that we would run. Is we look at the profitability of a company and we say, if a buyer were to purchase it and the bank finance 60%, how much money is left over at the end of the day? And if they can't cash flow, it's probably not saleable. The other key piece too is it takes time to sell a business. There's a lot of preparation involved. Typically, when you go to market, you're looking at 8 to 12 months from inception to closing. Prior to going to market, you probably want to ensure that you give yourself 2 to 3 years. The tax planning piece is absolutely essential, and that is one of the most important considerations, especially if you're looking for the capital gains exemption. Another key piece too that is sometimes in place is that people come to us with a deal team. They've already got a lawyer who's well versed in M&A. They're not a generalist. They also have dealt with a tax accountant or have spoken to a tax accountant and perhaps a evaluator. If you've got the right profile of individuals on your team and they're all collaborative, we can tell you that your chances of selling and getting what your business is worth go up significantly. So keep that in mind. You want to look for an M&A practitioner who's collaborative, who can point you in the direction of the right advisors if you don't have any, or is at the very least willing to work as a team, because it really does take a team to get the business across the finish line. And as I alluded to earlier, a vendor take back or seller financing is really an expectation. Gone are the days where you're going to get 100% cash on closing. This is not only a bank financing criteria, but even buyers coming to the table, there's no way they can assess all the risk. So seller financing is just one of those items that will offset some of the risk and give them a level of comfort and allow them to close the deal while providing fair market value for the business. Lastly, the amount of work on the buy side is significant. So if you get a good M&A advisor, what they'll tell you is there's a lot of upfront work on the seller side, getting due diligence, documentation in place, getting the SIM in place in the teaser, getting a marketing strategy in place. Once all of that is loaded in the data room and is ready to go, the attention should be focused on executing the marketing strategy and finding the right buyer. Once the buyer is identified, there's a lot of work that needs to be done. You have to make sure that they're dealing with the right lenders, they have the access to the capital, and they essentially are capable of pulling the trigger, and they have the right deal advisory team as well. So there's almost an equal amount of work on both sides of the equation. So keep in mind that you want to find someone that's also going to guide the buyer to the finish line. Here's an interesting observation. How many hats do you wear? And this really does speak to the level of attractiveness to the market and to interested buyers. How many roles do you play in your organization? Some of the questions that will help you really identify how closely tied to your business you are is if you go away for a month and you completely disconnected, what would happen to your business? Similarly, if you're to retire, would your business appeal to an investor because you have management in place, or to be appealing to someone who is looking to purchase a job? If in the ideal scenario that you got both management in place and you're easily replaceable as the business owner, you're going to appeal to both camps, and you're really going to give yourself the greatest opportunity of success. If you're smaller enterprise, chances are you're going to appeal to someone who's looking to buy a job, and the buyer pool will be a little bit smaller. It's not that it can't be done. It'll be a little bit more of a grind in terms of finding the right fit. So what do you have as options when you're looking to sell? Or when you're looking to transition your business? The preferred options really would be a management buyout. You have people in place, they know your business, they're interested in your business, they want ownership. You likely had a conversation with them, they'll take over. And the bank loves these. I think it's the safest at the end of the day. That's always a good option. The next one is transitioning to the family, next generation. As I mentioned earlier, there are many, many fewer transactions that we see that go down this route, but they still do exist. More commonly, we're seeing people go to market. The folks need the money in order to retire, and they need to get fair market value. They can't afford to transition it to the next generation. So that's one of the driving forces that's really pushing people to go to market. Lastly, you put management in place, you continue to own the company, and you keep your finger on the pulse from a distance. We do see people do this. Oftentimes when they come to us, though, they're looking to shed responsibility. They no longer want the headache. They don't want to be the sole decision maker, but it is an option. Some people do find that, hey, I can put a CEO in place, act as the board, still be somewhat involved, and still have some good cash flow. So that's an option as well. Some of the last resorts, and hopefully none of you will experience this, you don't have enough money from the value of your company, so you have to continue working. Another one is, there's really no buyer out there, or you're in an industry that's declining. So you have to wind it down and close the doors. Lastly, you lose your customers, or you get sick, and the only option, because there's no buyer who's willing to quickly purchase your business, is to liquidate the assets, and you simply walk away and take a bit of a hit. But again, hopefully you don't have to go down that path. So preparing your business for sale, what's involved? Tax planning is really the key. When we're talking about 2 to 3 years out, you want to make sure that you talk to someone who's well-versed in tax and is really up to date on the latest standards. It has become increasingly complex, and I can tell you that having the right tax advisor is well worth it. The last thing you want to do is find out after you sold your company that, had you restructured things, you could have saved a lot of money. A personal financial plan, another piece that's critical. Can you afford to retire? You really don't know until you sit down and figure out what your personal lifestyle needs are. And you also got to think about what you want to do post-retirement. Are you paying for your kids' education? Are you looking to travel? These are the sort of things that you really need to mull over to put a good plan in place. The other piece really is around, the psychological and mental preparation of retirement, thinking about trips, adopting new hobbies, thinking about a different routine. You need to start thinking about what retirement looks like, what your life looks like, well before you begin to sell your business. Lastly, when you're preparing your business, put your foot on the gas, make your business look as appealing as possible to buyers. You are competing at the end of the day, and you want to draw on the A-grade buyers. So make it profitable. Make sure that you identify the growth opportunities. Make sure your top line and bottom lines are growing. Make sure that you invest in capital so things look fresh. Next, make sure the business is less reliant on you. Put some management in place if you can afford to do so. Try to appeal to investors and the individuals looking to buy a job. Try to drum up more competition. See if you can get above fair market value. by having a few parties at the table. Really important too is operating procedures. Have some documentation in place so when people come and visit, they can see that you're organized, that your thoughts are written down on paper. Employees know that there's an operation manual in place. It's really going to help with transition as well. So if you don't have these in place already, sit down, get them in place. It'll definitely be very appealing to a buyer. Not all businesses, well, many businesses don't have these in place. So it's likely one thing that'll set you apart. Financial statements. Ensure you have the right firm, first of all, that's doing your financials and your tax planning. And then make sure you have suitable management reports. How do you measure the success of your business? There should be some KPIs in place. So make sure some of these pieces are in order so that when you have a buyer come to the table, there's something for them to look at. High-level overview of the selling process. So here are the steps involved that you would have to navigate from start to finish. So firstly, you would hire your advisor, which would be part of your deal team. You get a valuation for your business. You would gather all the key information. You would expect your M&A advisor to be doing some due diligence up front. Obviously, that's required to get your business valuation done, but they should also be looking at the other information available to make sure there are no significant gaps. After those first three steps are hammered out, you'd move on to creating the SIM and the teaser. So the confidential information memorandum, or SIM, is really the key document that's passed along to vetted buyers. This really shows the state of your business. It shows opportunities. It shows vulnerabilities. It really lays out enough information so buyers can make an informed decision. Do they want to move forward, or is this not a fit? The teaser, on the other hand, as I'm sure many are aware, is really a one-page document that doesn't identify the business, but provides enough information so people can get an idea of whether or not the opportunity is of interest. This usually gets disseminated to a fair amount of people just to see if there's need for them to see the SIM. The next step after you've got your SIM and your teaser is really having a marketing plan. How are you going to find the buyers? And this is a really critical step. And oftentimes a lot of people don't focus on this piece. They post the opportunity, or they post a teaser on a site, and they wait for buyers to come to them. It's really not a good strategy. It prolongs the process. It also attracts tire kickers. You want to ensure that there is something very specific around how buyers are going to be brought to the table. So after you have your strategic marketing plan, you go to market. You start identifying the buyers, and you start reaching out to them, and you start assessing fit. And once you find a few folks who are suitable, you negotiate with them. You ensure that you get a letter of intent put on the table, which is essentially an offer. Hopefully you've got a few offers you can choose from. You can do a little bit of work on who the best fit is. You choose the offer that's most appealing, and then you move forward. Moving forward would entail them doing some due diligence along with their advisors, a lawyer and accountant. And then finally, what would happen is the lawyer would put together the final touches, which is the sale and purchase agreement, and would close the transaction. After closing is when the transition period would start. And what we're seeing is sellers typically stay on board for at least 6 months to help out, whether it be part-time or full-time. It really depends on what the buyer is looking for. So let's jump into some of the particulars here. So selecting the right M&A advisor, really important. You want to make sure that they work in the lower mid-market. If your business is valued at $5 million, make sure that they've actually sold businesses that are worth $5 million and that they've got a pretty good buyer's pool in that space. If they're from a larger firm, what I would say is typically their sweet spot will be above 20. If they're a business broker, chances are they're really good in the 1 million and below space. So make sure you ask the questions, make sure that you ask them to talk to a couple of clients to ensure that the expectations that you have are being met. The role of the advisor intermediary is really important, and they should be very team oriented. They should be the project manager. They should be ensuring that there's a timeline and things are moving along in a timely fashion. They sit between the buyer and the seller, and they make sure that all the boxes that have been identified are getting checked in a timely fashion. And also very importantly, lines of communication remain open. They want to make sure that both the buyer and seller are working collaboratively. They're working toward a win-win situation. And at the end of the day, both parties can continue to work together. The last thing you want is two parties working against each other and negotiating in a very unprofessional manner, which creates tension and stress for both parties. That's definitely not what you want to have happen. The M&A advisor too should really have a success fee base in place, meaning, there'll likely be an upfront fee to make sure you're committed, but the majority of money that you're paying should really be based on them closing the transaction. If you're paying a significant amount of money every month to retain them, I would really question whether or not they're going to get the job done. The firm that I came from, which was a national firm, much larger firm, we would often engage folks that were smaller, and we would use a monthly fee arrangement. And what that really signaled was, we have more junior people who are going to be on it. We're not 100% sure if we can sell it, so we're not going to offer you a success fee based engagement. We're basically going to put time in, and you're going to pay for our time that we spend on the engagement. It's really not the way to go in the lower mid-market engagement, in my opinion. As mentioned, ask for references, speak to existing clients. Clients that are currently engaged and midway through are always really relevant to speak to. They can talk to you about how things have gone. Also ensure that they have a strong network of bankers, accountants, and lawyers, business coaches, and that sort of thing. That's a good indication that they're collaborative and that they work in teams. Lastly, you're going to find that in the lower mid-market, the M&A advisor likely works across a few industries. They're likely not specialized in one specific area, but likely hit a few different industries. Lastly, what you want to check to see is they've got good professional experience. They're well-versed in finance and accounting. If they don't speak those languages, there'd be a lot of trouble because they're really not going to be able to identify some of the key issues throughout the process. Business valuation, really important. This is really the essential document. What I mean by that is if you're looking for a win-win outcome, you need to identify what fair market value is. The buyer's really depending on it, the bank is depending on it, and the seller's depending on it. Gone are the days where you go to market expecting to get 20% over fair market value. If you can go to market with fair market value, and the buyer agrees and the bank agrees on that particular number, we would consider that a win-win. It's really important when you're looking to get bank financing. It's really important for negotiations and building trust. The valuation too should really address tax and the tax implications, working capital, the capital requirements required for the business. So an example of that would be, how many trucks do you need to purchase in the next 5 years? If all the the equipment is dilapidated and there's a lot of money that needs to be invested, that needs to be factored into the valuation as well. And also, what type of sale are you looking for? Is it an asset sale or a share sale? There's a huge difference between the two, and you definitely want to make sure that the valuation addresses which one makes the most sense. The gold standard in Canada for evaluator is the CBV, the Chartered Business Valuator. Larger firms will usually have one. This is something you want to look for, especially if your business is above $5 million in value. If it's below, you can get away with someone who's well-versed in valuations with a different designation. Again, the report that you're going to get, the valuation, in other words, will have a range for fair market value. There'll be a low end and kind of a high end. What you'll find is the other considerations, which are qualitative, the level of owner dependency, the the customer concentration, the location, the level of competition, these sort of things. Those are the pieces that can take it from the low end of the scale to the high end of the scale, really depending on how you rank in those pieces. So keep that in mind. It's not just a number exercise. There are quite a few qualitative pieces that need to be factored into it. The other piece is it's not an exercise where you're looking at 1 year in isolation. You're not looking at your best year and saying, okay, let's use this year and let's create a value for my company. You need to look at a few years, at least 3 years. Typically, we see 5 years. And the financials need to be normalized, meaning, all the, one-time sales amounts that you make that'll never come back, or, the COVID is another example where, there's a huge dip in revenue. These things need to be normalized. Other costs that occur very infrequently need to be removed as well. So the buyer's really seeing what a normal anticipated financial statement will look like. With the COVID, we're getting a lot of questions about business valuation. What I say is, it really depends on the industry you're in. It depends on how you've fared. It depends on how you've reacted to COVID. What I would say is that the key piece really is doing all you can to readjust your business practices, to look at your business strategy, reevaluate if needed. Try to get your business back to that historical norm. If you can't, yes, obviously the business value will go down. But for the most part, if you do get back to normal, you can preserve the value of your business. Will banks finance the company? Absolutely. If you're in an industry and we can show that the profitability is still there, the customers are still there, there's no issue with getting you fair market value. Due diligence. This is a huge piece. I mean, in the lower mid-market, it is really hard to assess all the aspects of a business. I mean, there's a lot of owner dependency. There's limited documentation. This piece is really important. The buyer and their advisor are going to look through all the information you provide them with. And the more you can provide them with, the more comfortable they're going to be. What we do with due diligence is we collect a lot of this information, if not all of it, right up front before we go to market. We load it up into a secure data room. That way, when we have an LOI on the table or an offer, we can open up the data room and let the interested buyer and their advisor start looking. So there's no delay. It's really critical. Typically, the accountant and lawyer on the buyer side will go through this information. Some of this stuff will include, HR related stuff like employee contracts, the suppliers list, customer lists, management reports, financial statements, some of the legal documents like articles of incorporation and that sort of thing. Usually it takes at least a month to gather all this information. A lot of people haven't updated their minute book, so that's something that they're going to want to do. Some people got to track down some of the legal documents and look to put some of the management reports in place. So yeah, it does take some time, but it's good to get it out of the way up front so that when you have someone at the table, you're not scrambling to find documents. And at the end of the day, the M&A advisor should be providing access to these folks to the buyer after they have a suitable LOI and once these people are vetted. Here's an example of the table of contents of a CIM. Typically, there are 50 to 150 pages. And if you haven't read one before, they're very detailed. They say a lot about the company. They talk about future opportunities. There's an assessment of what the company is doing well, what other opportunities for improvement there are. It talks about the industry, talks about employees, it talks about sales. It touches really on all the key aspects of the business. And, quality CIM is worth so much. This is really the first impression that a buyer will get on your business. It's also the first impression you're going to make to the bank. So when the buyer takes it to a bank, this is what they see. This is representation of your business. And if it's poorly constructed, it's likely going to, make your business less appealing at the end of the day. So it's a document where you don't want to carve out sections. You want to make sure that you address all the key issues, and you're not hiding things. You're being open about them, and you're presenting things as they really do exist. Because if you don't, and there's discrepancies between what's reported in the sim and the due diligence documents, you're essentially just going to create an issue down the road, and it's likely going to blow up the deal. Here's the teaser. This is the one pager. It shouldn't disclose your name. In fact, if people Google using all the keywords here, they shouldn't be able to find your business. It should provide interested parties with enough information to help them decide to move forward or not. Typically, when they see the teaser, they'll look at the revenue and they'll say, okay, this business does 12.2 million. We know that the value is likely going to be above 10 million. If I'm a buyer, I'm looking at this and I'm thinking, I'm looking to buy a $1 million business. I'm not going to be asking for the sim because it's likely above my price range. So there should be enough information to give you an idea of where the business is located, what industry, and how they've performed. And, once you get a flavor of what this is all about, hopefully it'll generate some interest and people will move forward, signing an NDA and then requesting the sim. Back to the marketing plan. This is such a critical piece, and it's really overlooked by many firms. It's not an exercise where you post a teaser on a few platforms and you wait for someone to emerge. It's really an exercise where you're understanding the ideal buyer profile, whether it's someone looking to buy a job or an investor, and then leveraging all the contacts in your network to ensure that you're reaching out to the most relevant people. What we found at Portage is, we get calls every day. We get calls from buyers looking to buy businesses, and we may not have something for them, but we'll take the time to sit down, we'll vet them, we'll gather as much information as we can, we'll put them in our CRM, and when an opportunity arises, we'll reach out to them. Currently, we've got over 1,000 people looking for businesses. So many times we don't even post opportunities on our website or on various platforms like Businesses for Sale, because we've already got qualified people who've been waiting for the opportunity. And really that's the safest way to go. This will ensure there's anonymity with respect to your business being for sale. Employees won't be aware, customers, suppliers won't be aware, and that's really what you want to ensure at the end of the day. And again, this marketing plan is an ongoing process. You need someone who is working on this day in, day out. They're going through and executing on a list, on a specific approach. You do not want to wait for someone to emerge. You want to ensure that you're actively working on this marketing plan. And lastly, again, you want to make sure that everything is done in a very confidential manner. When people are reaching out to interested parties, the last thing you want to do is disclose who the company is. It especially gets dicey when you're looking at competitors. You have to be very cognizant of the information you're sharing, and obviously they've got a vested interest in knowing who this business is. And you've really got to do a good job assessing whether or not there's a true appetite there, and it's worth the risk of providing them with more information. Negotiating and letter of intent. I mean, this is a really important part too. And, a big part of what the M&A advisor does is ensures that the relationship is kosher between the buyer and seller. You want to ensure that you have a good understanding of what the seller and the buyer is looking for, and you don't muddy the water between the two parties. You want to make sure that you don't make them compete against one another. You want to ensure that communication is open. Documentation's on the table. You're being truly clear, honest, and transparent with both parties, and you're getting them to build rapport with one another. That's really key. The letter of intent is the offer document that I'd mentioned earlier. It should really address all the key items. The last thing you want to do is have a letter of intent that is so general that doesn't capture a lot of the key pieces, because ultimately what you're doing is delaying the inevitable, which is talking about the critical pieces. How are we going to value this thing? How is it going to be paid for? How long is the seller going to stay on for? Is there an earnout in place? What is the vendor take back? All of these pieces should be addressed up front. The last thing you want to do is have an LOI, lock it in with a particular buyer, and have them grind through due diligence and then find out you didn't talk about the most critical pieces up front. You've now wasted months. So I can't stress that enough. You should be laying the groundwork in the letter of intent. And again, you want to make sure that you're working toward a win-win scenario. And this LOI too, at the end of the day, if you do it correctly, it will form the basis of the sale and purchase agreement. So a lot of the heavy lifting will be done during this phase. After the negotiation LOI, when the buyer's doing their due diligence, really a lot of stuff gets turned over to the lawyer. They're now I guess formalizing or putting the letter of intent information into a sale and purchase agreement. They're notarizing it. They're making sure due diligence is done on their end. They're finalizing all the legal documents. They're handling the money from the bank. They're making sure that they're working with the other lawyer to make sure that everything is in place and they get things done in a timely fashion. And I can't stress enough how important a lawyer really is in this process. Having a generalist is not recommended. You want to find someone that does numerous transactions over the course of a year. Finding someone who works at a small shop who's a generalist may sound appealing and may sound as though their hourly rate is really low, but what I can tell you is what typically happens is because they're not well versed, they're going to be asking for stuff that is not very typical. They're going to be recommending stuff that's not typically recommended. It's going to create a lot of back and forth between the lawyers, and the amount of time that they'll spend at the end of the day will be far greater than getting someone who's really experienced in this piece. So I can't stress enough, paying more money for an experienced lawyer and tax accountant is definitely worth it. In the end of the day, you'll be better covered, better representative, and it'll go along much quicker, much smoother. So in summary, plan in advance. Start 3 years before you're looking to transition your business. There's no harm in starting before that. Put your plan in place, get your deal team in place. Typically, when you go to market, it's going to take you 8 to 12 months. So keep that in mind. Make sure you get the right deal team in place. You know, if you come to us and you sit down and have a conversation, we're happy to talk to you about what the right profiles look like on the accounting and legal side. We've got lots of contacts that we work with that are very suitable in this space. So if that's something of interest, do not hesitate to reach out. Also, the M&A advisor, they should guide you through the whole process. They should really be the project manager. They should make sure that you're working toward a win-win. And ultimately, you should be running your business through this process. If you're finding that you're doing the majority of work, you're probably not working with the right M&A advisor at the end of the day. Thank you for joining us. This concludes part 1 and part 2.